Good afternoon, everyone, and welcome to Care Connection, the live webinars from the Alzheimer's Foundation of America. Today we have a very special guest speaker. Her name is Alice Sang, and she's from the American Advisors Group, and she's a licensed loan officer out of Melville, New York. Today's topic is going to be understanding the benefits of reverse mortgages. So Alice, please get us started by telling us a bit about yourself.
Okay. Well, let's see. There's me. That's how I look. My name is Alice Sang. I'm based in New York myself. I am a licensed originator in the states of New York and New Jersey. And actually, prior to this line of work, I was in advertising for 15 years. And when I decided to switch careers, I considered many things, and I had some background in mortgages, but, otherwise didn't really know much about reverse mortgages. The point being that I learned this program from the ground up and, really believe in what a great benefit it could be to families. And it is so misunderstood, and it is so underutilized. And I want to thank the AFA and Molly Fogel for giving me this opportunity to present it to folks like you, families like yours, because even in the very beginning, I think, Heather, who is sitting here with me, didn't really understand the benefits. I will say I drank the Kool-Aid almost, So I will get into the details about that. Other background, I want to give you my contact information if you have any questions, specific, deeper dive into the program itself. You can reach me. That's my phone number, and my email address. And you'll notice that there's a Gmail address and there's a aag.com address. So I work for AAG. That stands for the American Advisors Group. And you may have seen some advertisements and television communications with this gentleman, who is our current spokesperson. And almost invariably, when I show up for client meetings, people will ask me, "Oh, is Tom right behind you?" No, I can't produce him in the flesh, but he's done a great job for us, and we're very grateful. In addition, American Advisors Group. Let me click through some of this. American Advisors Group happens to be the #1 lender in the reverse mortgage space. And reverse mortgage is all we do at AAG. And we're dedicated to treating every consumer with dignity and respect. This is especially important, of course. Reverse mortgage, whether you're on the line today trying to find out more information for your family, maybe for your parents. But at the end of the day, our clients, the borrowers, are all 62 and over. That's a basic eligibility. And so, it's important that, we're guided by a particular sensitivity toward our target audience, as far as, getting them to understand and guiding them, and sometimes holding their hand through the process, which can feel somewhat complicated, because by law we have to make a lot of disclosures, especially given that there are a lot of regulations that have come in after the 2008 mortgage market issue. Which, by the way, did not really touch the reverse mortgage sector of the mortgage industry. Additionally, we are at AAG an approved lender of HUD which is the Housing and Urban Development Agency of the federal government. We are also a proud member of NARMLA, which is a trade association for reverse mortgage companies. We do gather together with the governmental officials to figure out how to improve the programs, how to better benefit our specific target audience. We are accredited by the Better Business Bureau, a mouthful, and we do operate on being caring, driven, and ethical in all of our business dealings. So it is a seminar today. Let me go back and cover the agenda, okay? So why am I here today? I touched on that a little bit. I alluded to the idea that, I knew very little, nothing really about reverse mortgages. Having just residential mortgage background, I've always thought it was a privilege to be able to borrow, 70, 75, 80, sometimes 90% of a house that you want to buy, right? So your regular mortgage is income-based. They'll look at your credit. And, really, I've also lived in different parts of the world. And not everywhere you're going to have that privilege to be able to borrow such a large portion of, a house, an investment, and basically get to enjoy that property as your home. And so, when I was learning my way into reverse mortgage, the first thing was I thought, this is a very creative use of the concept of mortgage, but how does it really work? And, learning it from the ground up, it's not complicated, but it's not a well-known program or product. And so, of course, the agenda today is to provide information and educate. And yes, you would have to be a homeowner for this to be relevant, or want to be a homeowner for this to be relevant. And the other thing that, always comes up is reverse mortgage has historically struggled with some misconceptions, and it continues to struggle with misconceptions, misperceptions, and, a negative reputation. But the information is important, and as you learn your way in and, ask your clarifying questions, you'll begin to see that much of it, the misconceptions, unwarranted, and it's actually counterproductive because at the end of the day, this is a mortgage program that can provide real solutions for families. Okay? All right, so let me dive into the meat of the presentation, which means I have to skip past through this slide that we've already covered. Okay, so for retirees, and retirees in my definition here would be 62 and over. Okay, and I understand that the AFA audience, may or may not be specifically in this category, but for the purposes of a reverse mortgage, the relevance is that you need to be 62 and over. Okay, as many of us know and feel, there's an increasing cost of living. We all know prices are going up and paychecks are not, or retirement income certainly, would not be rising as much. If you've already started collecting Social Security, for example, right, you'll get that set amount. In order for you to try to get more out of that, you were, meant to wait. So we've got an issue, a concern about increasing cost of living, and that fixed income I just talked about. Whether you're well planned out with a pension, and Social Security or some investments, The truth of the matter is that, you're on some sort of a budget, and that's a consideration, okay? Many folks want to remain in their home. I don't think I've never heard anybody say, yes, please put me in a nursing home, right? So whatever type of assistance you may or may not need, retirees want to stay in their own homes, age in place, whether it's a retirement home, whether it's in a retirement community, or just, the same house that they've spent the last 4 or 5 decades in, right? Also, this goes, for really anyone, retirees or not. We don't want to be a liability to our children or others, okay? And going back to the financial concern, if we have any investments, meaningful investments, will that last as we tap into that in our retirement years, right? And you can budget, but, there are going to be bumps in the road. There are going to be unanticipated items, although the unanticipated really should be the given, right? Whether it is medical costs, home improvement, down tree, that's going to be a couple $1,000s, and it's on your property. It's your responsibility, right? So really, unexpected expenses should be expected, yeah? And in this particular AFA audience, I'm keenly aware that there are additional considerations, special considerations, and sometimes, costs. Really, money is hard to discuss, and it's not one of those things that, immediately is what you try to tackle when, we think of, mom or dad is starting to show signs or is struggling with, certain memory or certain, mobility issues, et cetera, right? But it's very real. And so it's a lot to think about, yeah? And a little more food for thought, just some interesting facts, okay? And these points are all drawn from annotated sources towards the end of the presentation if you're interested, right? So the majority, almost all of us, make no advanced plans for eventual senior care needs, right? So senior care, I could start, at 62. It could start at 72, anytime. But most of us don't like to think about it, and so we make no plans. And, that affects everybody around us. Because at some point, 70%, again, another majority number, 70% of us will require some form, okay, extensive or mild, but some form of care in our lifetimes. And if you're a part of a couple, for couples, there's a 91% chance that one of the two will require care. That's almost for certain, okay, that there will be care needed, there will be care that costs money, and there will be care that was not planned for, yeah? And here's the other thing. Most people have the wrong impression that medical insurance will cover long-term care. So medical insurance is for more critical, for more acute conditions, right? But let's say you have mobility issues. Let's say you have, dementia or Alzheimer issues. You have your functioning days, your functioning moments, your functioning hours. but you need supervision. But there's, nothing acutely wrong that should put you in the hospital. Insurance, medical insurance is not going to cover that. And, some of you may already know this really well. And the cost of senior care, specialized or not, ranges anywhere from, almost $33,000 to, look at that second number, $103,000 a year, right? So I'm based in New York, and I have clients that, have basically spent down their savings. 24-hour care costs $6,000 to $8,000 a month, and that's on the cheaper side. So, when they spend down, they originally sign up for home care, and they have savings, so they have a contract, and everything's going well. But as the years pass, and they're watching their savings dwindle. And I've got some stories where people just don't have the information. I have a client who, racked up what ended up being about $27,000 owing to the home care agency. And they had this contract with the home care agency for a really long time. So, the home care agency was understanding, but where were they going to get not just the $27,000 owing, but also to continue that care? And so, by the time I'd come in and it was a little bit kind of save the day. And I was happy to have been able to do that. But also knowing that families out there can really benefit from, understanding that a reverse mortgage, right, or any financial tool that you can use and map things out earlier is better than putting yourself, your health, your finances at risk. Okay? And for most Americans, right, covering all this care and having their savings spend down, the one thing that they do have, for most Americans, okay, is their family home, which serves as their lifetime investment. Yeah, you sleep in it, you keep up with it, it provides you, lots of benefits. And most people, by the time they are of retirement age, have their mortgages, their regular mortgages, completely or almost paid off. Maybe there was refinance in there for home equity or for student loans, but, it's kind of almost human nature. You want to pay off your mortgage, right? But there's value that's locked in the house. All that time you've been paying down your mortgage, and the property value has risen and appreciated, hopefully, depending on the market that you're in. Historically, we see dips and then it comes back. But that value, that money that's locked up inside your home is called equity. Yeah? But unfortunately, many homeowners are what we call house rich, right? So you've got a house paid off or almost paid off, okay? But cash tight. Yeah? And a home equity conversion mortgage, okay, AKA, also known as a reverse mortgage, can provide financial peace of mind. Okay, then let me go into a bit more detail. So with a reverse mortgage, you stay in your home. It's a home equity loan. That's why it's called a home equity conversion mortgage. Okay. The difference, though, is unlike a home equity loan, you don't have to make any monthly payments. Okay. It's a home equity, more accurately, it's a home equity line of credit. And when you borrow a regular home equity line of credit, you do have to make some sort of payments, but not with a reverse mortgage, right? So if you just go to your bank down the street, you know, and you take out $50,000, $100,000 against the house on a home equity, you may have to make $250, $300, $350 in regular payments, and then in about 10 years that comes due, and then your payments jump up, but not with a reverse mortgage. Okay, not with a home equity conversion mortgage. As shorthand, I'm going to start calling home equity conversion mortgage HECM. HECM is for you know, all intents and purposes, a reverse mortgage. Okay, and you don't have to make repayments. You may if you'd like, because it's a line of credit. You can use it, pay it down, continue using it. And as long as you are paying the property taxes, right, which you have to do to protect your house, and insurance, and keep the house in good repair, right, all things you would do as a homeowner anyway, okay, you do not have to make repayments, okay? You can use the proceeds of a HECM, this type of home equity, for anything, especially for retirees. We're looking at home care, home improvements. You can even use it to finance your next primary residence if you were considering moving. And, you know, I was going to say, this is probably not a pertinent point for this audience, but I actually am correcting myself in real time. You know, what if because of family history or a diagnosis, you need to move, right? You need to either, you know, size down or, you know, find a more safe environment. That could be the case. Although the handful of Alzheimer's dementia cases I have personally assisted in, the family has, you know, always insisted on keeping the family member, the mom, in the original home, right? But otherwise, there isn't any limitation to how you want to or need to use the money that you would pull out of a reverse mortgage. Okay, so how does a HECM work? How does a reverse mortgage work, right? So most of us know how a traditional loan works. You buy a house, you make payments, and you build equity. You build the value, okay, that you consider yours, right? That's your equity. So you put 10% down, 10% of the house is yours. You put 20% down, you know, and as you pay that down and the house appreciates, then your percentage, your LTV, your loan to value in that house increases, and that's your equity, okay? In a HECM loan or in a reverse mortgage, okay, you stay in your home. It does make an assumption that you are almost paid off or you are paid off, but you stay in your home and you make no monthly mortgage payments, okay? You may, but it's not required, okay? You manage your own budget, you manage your own balance, and you let the equity pay you, right? Because it's locked. The value is locked. You're not using it. You're just sleeping in it, which is great, but it could do more for you, okay? Look at it as a financial tool in addition to a roof over your head, okay? So the eligibility for a reverse mortgage, you have to be at least 62. If you are part of a married couple, you may have a spouse who has not yet reached 62. That person is considered a non-borrowing spouse. That person does have to participate in some of the loan program documents and its disclosures, but it is possible to do it with somebody who's under 62, as long as one of the two within the couple, married couple, is over 62. You must own that home. You can be buying into the new home is one of the options, but you must own your home, and it must be a primary residence. You know, if you have the privilege of having a couple different properties, that's wonderful. The one that you can do a reverse mortgage on has to be the one that you live in as a primary residence. And primary residence is defined as 6 months plus a day. So it's perfectly fine if you're flying to your vacation home and coming back and forth. It just needs to be technically your primary residence where all of your, you know, your banking statements are going, your Social Security is going, okay, that's your basic mailing address, and if you have a driver's license or a non-driver's ID, that it's identifying that address as your primary residence. And you need to meet financial requirements for the HECM program. Financial requirements for HECM are very different than what most of you would understand as regular mortgage requirements, right? So you have to have like pretty high income, okay? If you were going in to buy a new home and you know you were borrowing 80%. The financial requirements for a reverse mortgage took into consideration, of course, fixed income for retirees, and you know, most folks on a fixed income we can work with, because we're really just looking at that you can cover your property taxes, your home insurance, and having some what we call residual income, some, you know, spending money. And depending on the region of the country, that spending money, that residual income can be, you know, $550 or so. Out on the West Coast, it's a little over $500 per person. Here on the East Coast, and it's a hair less in the middle of the country. Okay, requirements. Right, so I'll fly through these really quickly because it's a little bit detailed. Part of the process is that anyone applying for a reverse mortgage has to go through counseling. It's a seminar. It's kind of like a safe driver's course for money, okay? And it's also to check our work, right? I'm a licensed loan originator. I have to pass in a criminal background check every year. But this is added protection to make sure that the homeowner getting involved in this program knows what he or she is getting involved in, and also that the loan officer, you know, has been good and professional about disclosing everything that should be shared, including interest rates, rate caps, you know, how much money is available, how much money is available at closing versus a year later, you know, what happens, you know, in projecting into the future, 5 years, 10 years. We cover all of that as a specific client consultation, customized proposal to, you know, your personal situation when you do decide to get started, okay? You must also maintain your home according to FHA requirements, and the majority of those requirements are health and safety related. So, you know, if you've got cracking concrete steps going down to the backyard, that probably needs to be repaired, but, you know, it's not too onerous. It's not, you know, anything unreasonable. Although, you know, in my experience, there has been a couple of strange, unexpected fixes. So, you know, those are always good client stories to tell. And the last requirement is that, you know, you keep the house that you're living in safe, right? You don't want the municipal government to come after the house because you haven't paid your property taxes, right? They can lien against the house. And of course, homeowners insurance is critically important. So those are the requirements, okay? And then regarding repayment. So the repayment for a reverse mortgage is due when the last borrower, okay, or in the case of a non-borrowing spouse, that eligible non-borrowing spouse has left the home, okay, or does not comply with loan terms. So what does that mean, left the home? Okay, you can leave the home by selling, right? And you absolutely can sell. You sell anytime. There's no prepayment penalty. There's no strings attached. And, you know, so that's like the one big elephant that's always in the room. Reverse mortgages where they give you money and then in the end they take your house. No. A mortgage is a mortgage is a mortgage. This mortgage is highly regulated by HUD. It's insured by the FHA, and you have a balance, right? Whatever it is you use, that's your mortgage balance. And, you know, there are borrowing costs, as there always is with a mortgage. Whatever your borrowing costs and your original used principal, whatever that balance comes to, that's due when you either sell your home or vacate to a nursing home permanently. Okay, you could be in and out of rehab facilities, but as long as you're coming home, you're fine. You could be one of, you know, two spouses, and one of you, you know, must get care and assistance in a nursing home, and that's okay. But if both borrowers have permanently left the home, and of course, you know, when you have passed on, that is when the loan is due. Okay. The other repayment point is that the borrower and or the heirs who take over the estate can never owe more than the value of the property, right? So let's say you used up all of your equity. You know, you originally got out 60% of the value of the property, and your balance was starting to accrue because, you know, you're not making any repayments. But something scary happens, and whether it is an act of God or, you know, economic situation, as, you know, we saw a downturn in the market in '08, you know, we don't wish for it to ever happen, but when it does, in a reverse mortgage, you're protected, right? If for some odd reason your home ends up, quote unquote, underwater compared to your mortgage balance, you do have the option to walk away, okay? So you never, and your heirs would never owe more than the value of the property. This is one of the only non-recourse loans that exist. Non-recourse means the bank does not have recourse against you or anyone related to you, okay? It simply can only use the house, the property itself, okay, for accountability against the mortgage balance. And that's why it's an FHA insured program. If and when a situation like this happens, they go to the insurance pool, okay, to settle the difference. You know, if the difference is $50,000, $100,000, That's their backup, okay? And in a positive situation where you do have remaining equity, you know, you've only used 100,000 out of 400,000. The remaining equity belongs to the borrower and or the heirs, right? So if you sell, you know, just like a regular line of credit, and your balance is only 100,000, you sell, you settle, you walk away with the cash. Okay? How much money can you receive? That's, you know, a common question. What you get is based on 3 factors. It is based on the younger age of a pair of borrowers, or simply your age, and then the appraised value of the home. So the appraisal is done by a FHA certified appraiser. Okay, there is a limit. We can calculate a property value up to $636,150. $636,150. If you have $1 million house, that's wonderful. We can only use the value at $636,150. Okay, anything lower, we use the lower. So it's a $500,000 house, a $250,000 house, doesn't matter. We can go, we use the appraised value or up to $636,150. And then the current interest rate. So those are the 3 factors. They get plugged into the computer, and that's how we figure out what we can borrow against the reverse mortgage. So the younger that you are, the less you can borrow. The older that you are, the higher your credit limit will be set. Of course, the higher your value is, the more you'll get, and also the interest rate market plays into, you know, what you would be able to receive. Okay, as a really broad example, you know, if you're 62 and you have a $400,000 home. We're looking at about a borrowing limit maybe around 175, 180,000. Okay, we're not able to lend you, you know, the traditional type of loan to value like a 75 or 80% against the house. The math doesn't work that way. But, you know, depending on where you are, what you need the money for, you know, that kind of money can be very meaningful. And the way you can pull it out in lump sum payouts. There is a rule about keeping back a chunk of money with a year's wait. So there are some limitations to that. But you can take it as lump sum. You can take the money out in monthly installments. You can also set it up as a line of credit and let it grow. Right now, we're looking at a line of credit growth around 5%. So, you know, if you've got $100,000 or $200,000 of line and it's not being used, that security blanket is actually growing for you. Okay, or you could do a combination of any of these that I've just mentioned. Okay, what do people generally use reverse mortgage loans for? Lots of things. Paying off an existing mortgage. If you have a $50,000 existing mortgage and your regular payments are, you know, $1,000 because originally it started out as a mortgage that was $120, but you know, your current monthly payment of $1,000 is very taxing. A reverse mortgage basically does a balance transfer and takes care of your existing mortgage, and it has to. You are not allowed to have any other types of mortgages against the primary residence property that you're doing the reverse mortgage on. People use it to make retirement savings last longer. They can also use it as a line of credit. That's the LOC, what LOC stands for, as a standby cash reserve. You know, let's say you are very well planned and you have some investments. But what if, you know, it's a down year? What if the market is down and your nest egg is, you know, shrinking because of market conditions, and yet you're still pulling money out of that? You're making it shrink even more, okay? If that's a good time to dip into your reverse mortgage line of credit and allow your nest egg, right, your investments to recover a little bit. It can also be used, of course, to support age-in-place situations, you know, specifically caregiving, right? Caretakers or home modifications, you know, you need to install a ramp, you know, level out certain parts of the home, lower cabinets, whatnot. We're not going to touch on this today, but there's reverse mortgage can also be used to purchase a new home, as I mentioned before. And, you know, if you are sort of in the earlier consideration for retirement and you're planning around Social Security, you know, you can pull, you can use the payments or proceeds from a reverse mortgage and wait to collect your Social Security, because your Social Security, with every year that you wait, will become a bigger monthly check. Okay? So some people do that. Consumer safeguards. All right, so we'll run through this relatively quickly. There's no prepayment penalty, right? So you can sell and pay off. You own your home. You make the decision. There is a mortgage insurance that we talked about. Any and all FHA programs have mortgage insurance, and this was recently lowered by the FHA in on October 2nd, actually. There were new rules around this program. We talked about you never owe more than the home is worth. You have to, it's required, to get some counseling and understand the program from an independent third party over and above what your loan officer may tell you. There's that non-borrowing spouse feature. So when you have somebody who gets into the program with you who's under 62, that non-borrowing spouse is protected, because if you're the older spouse and you qualify and you're the borrower and you pass away first, your non-borrowing spouse, okay, continues to live in the home, right? So he or she is protected. That person cannot tap into what may be left of the line of credit, okay, but will always be able to live in the home as long as the terms and conditions that were agreed to are abided by. Okay, and also, as of about 2-3 years ago, we are also required to go through a financial assessment, client by client, to make sure that in the longer term, it's a good and suitable solution, and that, you know, you have a positive outlook to stay within the terms and conditions of the program, and it's not just, you know, us selling you something in the upfront that is not really sustainable for the longer term future. So those are the safeguards. We have some common questions that pop up, and I'm also aware, though, that time-wise we might be starting to, it's an hour long, we go till 2 o'clock. So let me pop through some of these questions, and it's a good time for you to also let us know what questions you may have by tapping them into the message board, and we can start to answer these one at a time. So one of the, and I have 5 of these, and I may or may not have the time to answer all of them completely, but you know, you have my phone number, it'll come up again, and you have my email address. So the one misconception, right? It's not even a question. Is, does the bank own my home? No, it does not own your home. It has a mortgage interest just like any other type of mortgage, okay? But you own your home. You buy your home, there's a mortgage on it, you pay it off, you put another mortgage on it, but you still own your home. It's the same thing with a reverse mortgage, not any different, okay? Question 2, with a reverse mortgage, I would no longer have the option of selling my home. Okay, so we covered that already. Okay, it's not true. You sell at any time. In fact, you could, and I've done this, you could modify your home with a reverse mortgage, right? So you do some home renovations, you enjoy it for a few years, and then you decide, oh, you know what, I'm going to move now. I'm going to, go to my dream retirement home. As the case may be, in some situations, it's no longer sustainable. I have to move mom or dad into a new situation. And you can sell your existing home, right? That reverse mortgage has to be settled, okay? But when you go to buy your next home, you can use the reverse mortgage again. So you sell for $400, you pay off a reverse mortgage for $150, you've got $250 left. Okay, you buy into a new house, okay, but you don't have to throw in all that $250. Okay, you can use the reverse mortgage again. Any couple, okay, any married couple or person can have one FHA loan at a time. Okay.
Okay, so I see that there are a couple of questions that we have coming in. Thank you so much, and we are going to pause on hard comment questions, and maybe they'll be similar. So I'm going to read this question. Yeah. It is from Michael. If I'm the borrower, if the borrower dies, the non-borrowing spouse cannot use the monies that were borrowed. What happens to those funds?
Okay, so if you're the non-borrowing spouse and the borrower passes away, and there is line of credit left, right? That's not real money. That's borrowing capacity. So let's say there is $50,000 left, okay? But your balance, right, you've used your line and the borrowing cost has stacked up, and you owe $100,000, let's say, and there is line of credit of $50,000 left. That line of credit simply gets frozen, okay, and the $100,000 of balance, okay, just sits there. The borrowing costs do continue to layer on until you, as the non-borrowing spouse, who is the decision maker, who is still the homeowner, decides to sell the home, or just continue to live in it. You just have to continue to pay your property taxes and your home insurance. Or if you are age qualified and financially qualified, you can also refinance your way into a new reverse mortgage whereby you're absorbing that original balance, and then you can open up your line of credit under your own name. It's not something I advise most clients. If a couple is nearing 62, I ask them to consider both being on the mortgage. But sometimes it's not, it's that urgent, for families to tap into the equity. And so it depends on the situation.
Okay, thank you. We have another question, both from Kendra. How much does equity have to be? And her next question is, how long after you purchase your home can you do this?
All right, Kendra, right? Let me answer the first one first. There isn't really what we call a seasoning requirement if you purchased a home recently. Let's say you just bought something and you're like, wow, light bulb, this is a great program. We can do something with you, immediately. There has been seasoning requirements around home equity loans, but those are being eased as well. I believe they've actually gone away. Very recently, as recently as 10 months ago, I had a client who, because they had a home equity that was recent, we had to wait out for a full year before we could do their reverse mortgage. We did it, we closed it, it was fine. But seasoning requirements, even for home equity loans, are going away, and I don't believe that there is any for purchase. So on a home that you own, you know, how much equity do you need? You simply need to be able to cover your existing mortgage if you have one, right? So if you don't have an existing mortgage, you have 100% equity, great. Okay, we could definitely do that. But if you have an existing mortgage that's small or still meaningful, we can help you get rid of that mortgage as long as the borrowing capacity we can lend you will cover that original mortgage. So if your house is worth $400 and you have a mortgage of $175 and you're turning 62, okay, we're right, you know, I'm just using doing the numbers right off the top of my head. You're right on that borderline, but if the numbers work, we can, okay, basically convert you into a reverse mortgage, and that repayment, that monthly repayment pressure of the regular mortgage immediately goes away. Okay, if you owe anything less than that, great. That would mean that you have some line of credit left over even after your original mortgage got covered. Okay, so it's not a easy, hard and fast formula that I can give you.
Her next part of the question, and I'm not sure if this was answered, how long after you purchase your home can you do this? Is there, yeah.
Right, so I answered the second question first.
Okay.
So there is no time limitation.
Okay. And we have another question, again from Kendra. Can non-borrowing person not be a spouse, say if they're not married?
Yes. Yes, a non-borrowing person can be. I've done applications where it's actually, you know, mother-daughter, right? If you're both over 62. However, you're right. Actually, let me rephrase that. The applicants, it has to be a non-borrowing spouse if you're under 62. Right? So if you are under 62 and you're not a spouse, then unfortunately, no, we cannot help you in that situation. But if you are not married, okay, but you are over 62, you do not have to be a legally defined married couple in order to both be on the loan, and we've had more than 2 borrowers. We've had 3 borrowers, let's say, on an application, and that's all fine. But yes, a non-borrowing spouse has to be a spouse to enjoy those benefits and protections.
Does a reverse mortgage have tax implications?
Okay, right. So let's touch on that, and also if we can jump back to where we had gotten to on question number 3, okay? So you are using your own equity in a reverse mortgage, and that is technically not income, okay? You haven't sold the home, there's been no transaction, this is your own money, okay? So there are no income tax implications, okay, for a reverse mortgage. So if you are pulling out $100,000, that's your money. There's no 1099 at the end of the year for it, okay? And you don't need to report it. It is tax-exempt, tax-free money, okay? And while we're on the subject, Another common question is, will it affect my Social Security or Medicare or pension benefits? No, there's completely separate tracks to that. Okay, we might, in the course of your application, check to see that your Social Security number is really yours, but that's really for identity fraud more than anything else. Social Security does not take into consideration that you do or don't have a mortgage of any kind. I had a gentleman who actually called me up with that exact question back in April. And then he also, when I told him, no, there's no impact, he then said to me, okay, well, I'll call you back in a year. That's when I'll be retired. And that's another misconception or something that people just don't know. I said, Robert, you don't have to be retired to do this. Why would you wait until next spring? And he said, what? You don't have to be retired? No, you don't have to be retired. You can be working. You can be working part-time, full-time. You know, if you are a money person, if you are really into investments, you can really see the value of having, you know, a standby cash reserve line of credit like this. You do not have to be retired to do this. And we closed in late May. He's happy as a clam. Spent the entire summer fishing. So we have questions 4 and 5, or anything else that may be on the message board. Okay, so let me jump down. So the answer to that, of course, is no, will not affect your Social Security. Question 4, with a reverse mortgage, would I have nothing to leave my heirs but debt? Okay, first of all, we covered this. You would never be leaving any debt to your heirs, okay? The house itself has to cover the mortgage, okay? You used it, hopefully you enjoyed it or whatever purpose it served, but it served a purpose. The house has to be accountable for that balance, that debt, but you're not leaving it to your heirs. And if there's any value left, and most times there is, that goes to your heirs. You have to remember, we lend you a good portion of your property value, okay? If you hold the mortgage for 5 years, 10 years, 15 years, the house, although there could be ups and downs and bumps along the road, in the longer term, property appreciates, okay? So that appreciation is helping to offset the borrowing cost, right? So, you know, you should think of it as, okay, I'm mortgaging half of my house and I still have the other half of the house appreciating. And that will go to your heirs, you know, upon your passing, okay? And the last and final common question, should a reverse mortgage only be considered as a loan of last resort? And the answer to this is no, and it couldn't be, you know, farther from the truth. It's actually a mistake to wait. You should do a reverse mortgage earlier on, allowing for your line of credit to have the chance to grow by that 5%, right? And, you know, you're grandfathered in when you're already in the loan program. So the rules could change, but they can't touch you, right? Your terms and conditions have already been set. You're grandfathered in. So, you know, we already touched on earlier, most people think they don't need care, but the majority of us do need care. So set it up, use it for whatever purposes, but also have it at the ready if you need care, whether it's acute care or longer-term care. It'll be available for you.
Okay. Robin has a question. My mom is 93. She owns her co-op apartment. It is in a trust to me and my sister. Is she eligible for a reverse mortgage?
Right. Okay. So this, the short answer, unfortunately, Robin, is no. Okay. This presentation is designed for the majority of the country. and co-ops are in specific regions of the country. Co-op ownership is a different ownership format than your fee simple property ownership, okay? You own stocks. Coincidentally, I live in a co-op as well, okay? We own stocks. We own pieces of paper. And unfortunately, the FHA and HUD cannot work with that. We can do single-family homes, multi-family homes up to 4, and FHA-approved condos, which are not that easy to come by either. Okay, but if you're in a condominium and it's an FHA-approved project, we can work with that, but not, unfortunately, not a co-op. Okay, and unless there are any other questions, that about wraps it up. And let me just skip through these eye charts and put my contact information back up again for you to take down. If you do have any specific questions, you can reach me, and I would be very happy to answer your questions, introduce you to colleagues in other states if I can't help you in New York and New Jersey. And thank you for your time today.
So I want to thank everyone for coming on to our call. I know I certainly learned a lot today. I had no clue what a reverse mortgage was before today's presentation, and I hope all of you who joined us today learned as much as I did. I want to welcome everyone back to next month's webinar. And just to let everyone know, we do have handouts. Alice was so kind to include her presentation in PDF form and some other handouts that we have through the AFA. If anyone has questions, you could always give us a call at 866-232-8484, and we'd be happy to assist. We are available Monday through Friday, 9 a.m. to 9 p.m. Eastern Time, and Saturday from 9 a.m. to 1 p.m. Eastern Time. Again, I want to thank Alice, and I want to thank all of you who asked questions and joined us today, and we welcome back all of you for next month's presentation. Everyone have a good day. Bye.